Do you have a 401k or a 401a retirement plan? Do you ever feel like you'd like to have a better understanding of what that means and how to make use of it? This video is going to cover what you need to know about 401a and 401k plans. So most of us rely on qualified retirement plans to save for retirement. But unfortunately, most of us just don't know the features or benefits of the plans that we use. I'm going to begin by explaining what a qualified retirement plan is. So qualified retirement plans are retirement savings accounts offered by employers to their employees. Your employer wants to give you reasons to stay at their company, and one great way for them to do that is to offer a competitive retirement plan that makes saving easy and convenient. Now, there are a variety of qualified retirement plans, and they're going to be different based on the type of employer you work for. So this video is going to focus on 401ks and the less common 401a, but we will touch on other options briefly as well. So 401ks are definitely the more common of the two types. If you work for a for-profit company, you're most likely going to have a 401k. If you work for a nonprofit or a government organization, you won't have a 401k. You'll probably have a 457, a TSP, or a 403b. But in some cases, and it can be a great perk to have this option, you may have the option for a 401a plan. The thing about 401ks is that if the company offers it for any employee, it has to offer it to all employees. Not so for 401a plans. So if you're at a government agency or educational institution, you'll probably have a guaranteed retirement plan that's a 457, 403b, or TSP, and the 401a is just going to be a bonus to keep you hooked. All right, let's back up a step. So what are the basic requirements to become eligible for a 401k or 401a? Just because your employer has one doesn't mean you can immediately start saving money into it. So for a 401k, you need to be at least 21 years old and have worked for the company for at least 1 year. For 401as, you'll also need to be at least 21, but you'll have to have worked for the company for 2 years. So now once you're eligible, you need to understand how your contributions are handled. In a 401k, the amount you save is completely up to you. You choose a set amount as a percent of your salary. Your employer will automatically ship that money off to a separate account held in trust for you. So let's say you have a salary of $100,000. You can choose to save 5% per year, and your employer will automatically deduct 5% or $5,000 out of your paycheck, so you don't have to think about it. In 401a plans, how much you save really isn't up to you. Let's say your employer offers you the option to participate. Great. Well, together, you're going to negotiate how much will be contributed to that 401a plan. You'll have some say, but ultimately, your employer is going to have the final word, and that's because in a 401a, your employer is required by law to match your contributions. So ultimately, they're going to choose because they have to put money in. Now, sometimes you'll find a similar matching arrangement in 401ks, but that matching arrangement isn't required. It's entirely up to the employer in a 401k. Let's do a quick example of matching math. The math is really the same for both 401ks and A's, so don't worry about that. So using round numbers, if your salary was $100,000 and you contributed 5% of your salary, that would be $5,000 of contributions each year. Now, say your employer matches 100% of the first 3% of your salary, and then 50% of the next 2% of your salary. How much would that be? Well, 3% of your salary is $3,000. 100% of $3,000 is $3,000. And then 2% of your salary is $2,000. 50% of $2,000 is $1,000. So we add the $3,000 and the $1,000 together and we get $4,000. So your employer will contribute an additional $4,000 on your behalf under that matching framework. A good rule of thumb is to consider contributing at least enough to maximize your employer match because it's essentially free money, so why wouldn't you? Now, there are a couple more details about 401ks that I'm going to get into in this video, so bear with me. But as you can see, retirement planning can be complicated. So if you're looking for some help and guidance around your retirement planning efforts, I've made a free training video that shows strategies and tactics that the most successful retirees are using to improve their retirement odds. You can access the video for free at app.thepeakfp.com/free training. All right, so to continue on, you may remember that just a couple minutes ago, I mentioned special tax treatment for 401k and 401a contributions. Your ears might have perked up, as do mine. So the question is, how does that work? Well, really you have two options. You have pre-tax or you have after-tax, which is also known as Roth. Pre-tax means that you get a current deduction in this year for the amount that you contribute pre-tax. So essentially what that means is you won't pay taxes on that amount in the current year. So using our previous example, if you put $5,000 in pre-tax, you don't pay taxes on that $5,000. That money then grows tax deferred, meaning you don't pay taxes in ensuing years. And then in retirement, when you want to access that money and take it out, you'll pay taxes at that time on all the money that you take out. So that's for the original contribution and the growth. After tax or Roth contributions work the opposite. You don't get a tax deduction this year. You will pay taxes this year on that $5,000, but it's going to grow tax-free forever. And then in retirement, when you take the money out, you don't pay taxes on any of it. So Roths can be extremely powerful if you think that tax rates are going to be higher in the future than they are today. 401k and 401a type accounts are really powerful tools, and they make saving convenient. They give you tax benefits, and they're managed by your employer, so you really don't have to do it yourself. But there are a couple pitfalls that you should pay attention to. The first is that generally you won't be able to access your 401k or 401k type money until you're 59 and a half. And that's because you're going to be penalized if you access it any earlier. Now, there are some exceptions to that, but I'm not going to get into that in this video. Just suffice it to say that if you need to explore accessing 401k type money before 59 and a half, you should absolutely consult a financial advisor or an accountant before doing so. Again, it's a good time to mention, if you're planning for retirement or you're just realizing that you should be planning for your retirement, I have a free masterclass training video that shows you how you can increase your income and avoid running out of money in retirement. So you can go to app.thepeakfp.com/free training. I'll flash that on the screen here. Again, it's app.thepeakfp.com/free training, and you can access that training video for free. So let's wrap up the 401k conversation with two final details. The first is vesting schedules, and the second is contribution limits. A vesting schedule is a timeline that dictates when the money in your 401k actually becomes your money. So contributions made by you, the employee, are always fully vested, and that means that they're always owned by you immediately. If you leave the company tomorrow, any money you contributed into your 401k is yours to take with you. There are tax consequences and specific ways to do that, so you should, again, consult a CPA or financial advisor for how to do that. But your employer contributions, the money put in by your employer, is usually going to vest over time, and that's something like 3 to 5 years. Every employer has a different schedule. And your employer does that so that you don't just jump ship and take the free money each year as you switch employer to employer. They want you to have a reason to stay at the company, and the free pot of gold that they've been contributing to you on your behalf is a pretty nice way to do that. So you should always make sure that you check with your employer about your vesting schedule so that you don't rush to quit or have a reason to leave and then leave free money on the table. Last but not least, let's talk about contribution limits. 401k plans have government regulated limits on how much you can save into the plan, and the amount changes year by year. So the best way to stay up to date on this is to check the IRS tables. You can do that with a quick Google search of 401k contribution limits. But for 2023, the max that an employee can contribute to a 401k is $22,500 if you're under 50 and $30,000 if you're over 50. For a 401a, that amount is $66,000, and there's no difference based on your age. Lastly, to wrap up here, let me remind you that 401ks are retirement saving vehicles. That's it. It's designed to help you produce income in retirement only. So pay attention. Make sure you're aware of the pitfalls. If you like this video, hit the like button, subscribe to the channel.